It has been about a month and a half since Liberation Day on April 2nd, 2025, when tariffs were unleashed upon the world, and now we're starting to see some real-world impact of what those tariffs mean to businesses and consumers across the United States. Now, while the United States economy still remains relatively strong, there are some warning flags, or warning signs rather, that are showing up that you as a business owner, as a consumer, would be wise to watch. And so in this video, I'm going to be sharing a few examples of things that may not be looking so great underneath the surface, starting with Walmart. So Walmart made an announcement recently that they are going to start pushing the costs of tariffs onto consumers. And this was a big announcement. One, because of who said it. Walmart is the low price leader. They're also the biggest retailer in the United States, with physical presence across the US. Walmart, being that low cost leader, is typically looking to hold the line. They are very strong, let's say, with their suppliers in pushing for the lowest cost possible. And even with all that aggressiveness and their huge revenues, they really only have 2 to 3% net margin. So on $650 billion of revenue, they only make about $15 to $20 billion every year on 25% gross margins. And Walmart making this announcement, in my opinion, has set off the starter's pistol, allowing everybody else the air cover to be able to make similar announcements or to make no announcements at all and raise their prices. You're going to see cost increases, but you may also see what they call shrinkflation, where you pay the same rate, the price doesn't go up, but the thing that you buy gets a little bit smaller. There's going to be a lot of stores, a lot of retailers that are going to start using shrinkflation again. They're going to start raising their prices, really because they have no choice, because their retail margins are so narrow and so tight that in order to stay in business, in order to keep stores open, they are going to have to raise their prices. And as far as other retailers, you're seeing announcements from some like Home Depot that will say they're going to keep their prices generally the same. That generally is doing a lot of work in that statement. And Home Depot is a bit in an enviable position because a lot of what they sell are big, bulky goods that don't come from China. They don't really come from the EU, two locations that will have the highest tariffs as of now. A lot of it's domestic or from local trading partners such as Canada and Mexico, which also have tariffs. So we'll see how hard Home Depot is going to be able to hold this line. The other one is Target. Target has mentioned that they will hold the price as long as possible. But again, I don't see Target being able to escape the gravity of the retail business and their thin margins. So we'll see what happens there. But again, I would expect to see shrinkflation as well as price increases across the retail spectrum. So those are the big guys. Let's dive a little bit deeper into the SMB world. So one of the businesses I work with is an importer that brings in product from the Asian countries, in particular China. They bring product in, they rework it in the US, and then they sell it off into the local US market. And this business is relatively new, about 5-6 years old, and what you would call a business success story. It has about 7-8 employees, has a real nice top line revenue, relatively thin margins, but given the industry it's in, is pretty healthy. And now this business, to their credit, saw tariffs coming months before Liberation Day. They read the writing on the wall. And so they were planning ahead, they cut costs, they increased their cash balance, and they tried to order as much goods as possible to build out inventory so they could kind of hopefully wait out tariffs and wait for better days. But despite all of their best efforts, they had goods on the water as orders were delayed and had to pay the 145% rate when the goods hit the harbor. And they ended up paying out of pocket tens of thousands of dollars to US Customs to bring these goods into the country. And now they're going to try and pass on some of these costs to their customers, but they're getting a lot of pushback where customers are saying, well, I don't want it if it's going to cost me tens of thousands of dollars more. And you had an agreed upon price, you need to honor that price, even though tariffs are a noted exception. They're in a rock and a hard place. Do they eat the cost and keep the customer relationship? Do they try to split it? Or do they say you take it and they'll push legal action potentially? They'll likely do some type of split, but even again, it's a really difficult situation for a business to be in. The next difficult part for them, and one they're really struggling with right now, is when do they place more orders? Because they have no idea where tariffs are going. They paid the 145% rate. 2 weeks later, tariffs dropped to 110%. So they're at a really difficult juncture because as they look forward to inventory purchases, they have to decide whether they buy more inventory now at the roughly 30 to 40% tariff rate, or do they wait with the hopes that tariffs drop even further and saving themselves thousands, if not tens of thousands of dollars? Or if they do wait, is there a risk that the tariffs could jump back up again to 145%? As we saw today, Trump is now threatening the EU with additional tariffs for not moving fast enough on deals. Will that same happen to China if the deal kind of takes a little bit longer? And so inventory is obviously lifeblood to businesses, lifeblood to this business. And if they're not bringing in inventory, they're not having anything to sell, and you start to die as a business. You start to fall into inertia, and it can be a slow or sometimes a very quick death for a business. And so they're in a really difficult situation, and business is really hard in and of itself. And now these tariffs have both increased costs and uncertainty, which is a really difficult place to be, especially for small SMB businesses where you don't really have a large vocal lobbying group advocating on your behalf. So it's going to be really interesting to see what happens to these SMBs, a lot of which are thinly cash constrained, a lot of which are on thin margins, and a lot of which drive the American economy. So something to watch. Now zooming back out again, you then have economic signals. And this week, on the Wednesday 21st 20-year bond auction, we saw what I would call a little bit of smoke starting to rise about the economic health of the country. And these treasury auctions are relatively straightforward. The government monetizes its debt, allows it to continue debt financing and fund different services. And over the past number of years, America's been in a very privileged condition to be able to have a lot more demand for its supply of debt, which keeps interest rates low in America. And this week's auction, you started to see some pullback, particularly from foreign investors, from foreign governments. And the interest rate went up a little bit. And this again is a little bit more smoke than signal right now, but it is a bit concerning, particularly when taken in with the overall universe of what else happened this week. The US lost its last AAA rating. You're looking at a tax bill that recently passed the House that will add potentially up to $3 trillion of additional debt. And the US debt continues to grow. It's at $36 trillion. And some people are starting to think that bill for all those good times is starting to come due. So when you add all that together, you add in the tariff uncertainty, you add in just the general business uncertainty, you're starting to see potentially why foreign investors, even domestic investors, might be pulling back from the US because they're no longer potentially seeing the US as that secure, safe place for their money. And if that is true, and this does become a trend, this will have significant impacts to your business and to the overall economy of the US, because with low interest rates and demand for US goods, for financial products, the US dollar has been strengthened over the last number of years, which makes other countries' goods much cheaper for Americans. It's also kept interest rates for American businesses, consumers, mortgages, credit cards, etc., lower than they would be if there was more of a free flow of capital and there were other safe hubs for capital to flow into. So the US has enjoyed a very privileged position. And this might be a sign that this could be coming to an end. So something to definitely keep an eye on. And one metric I would highly encourage you to take a look at is the 10-year note. Keep an eye on that 10-year. It has been going up, the interest rate, over the past few days, weeks, and we'll see where it ends up and how it reacts to the overall continued uncertainty. But right now, we're starting to see a number of those warning signs. As we discussed earlier, we're seeing the large retailers like a Walmart note they're going to start passing costs, that things are going to get more expensive. We're seeing even retailers that sound good on the surface, like Home Depot, Target, hedging with words like generally, or we'll try to keep this as low as possible as long as we can. And these are the big guys. Everybody underneath is likely raising prices or performing shrinkflation. So the consumer is going to be paying more out of pocket. We're starting to see the impact to particularly SMBs that import from other countries, which is a big part of the SMBs that are not in the service business. And SMBs drive a significant part of the US economy. Starting to see some weakness, some uncertainty, some hesitation in those businesses. And lastly, we're starting to see some macroeconomic financial indicators start to flash a little bit red. And now, with uncertainty ahead, with the tax bill potentially getting passed, there'll be a lot more potential uncertainty ahead, particularly as we haven't seen any tariff deals be signed. The UK announced one with the US a couple weeks ago, which kept tariffs at 10% for most goods, but nothing's been signed. Details are still being worked out. So there's still a lot of uncertainty on where these tariffs are going to go, particularly as we look to some of our biggest trading partners and China, where we import a lot of goods from. So keep your eye on it. Please do subscribe and follow. I'll be keeping you updated as situations continue to evolve. But as a business owner, would highly recommend you just keep an eye on those economic factors, on the 10-year, and stay informed, stay ahead of the curve, and be prepared for what might come down the pipe. Thank you for joining me. We'll see you on the next one.